who want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to the Morningstar. I'm Emma Wall, and here with me today is Andrew Bell, manager of the Witten Investment Trust, to give me his 3 investment tips. Hello, Andrew.
Hello.
So what is your first investment tip then?
I think we're always looking for undiscovered or underestimated growth, and I think one of those areas that I think now is coming back into favour is the banking sector.
It's very controversial, the banking sector, of course.
Yes.
If you'd played it right, like sort of hedge fund manager Chris Benodi, you'd have made quite a lot. But then before that and after that, you'd have lost money as well. So why is now the right time?
Well, you can either be the sort of wrestling with a lion person who buys the thing at the very bottom of the cycle when it's extremely cheap, but it might go bust, and we didn't do that, or our managers tend not to do that. Or you can buy a sector where there's a bit of a hangover of poor sentiment because of obviously how bad things have been, but where the outlook for the economy is improving, therefore the bad debt charges are going to go down, lending growth is probably going to pick up, capital has been rebuilt. And I think that's, broadly speaking, where we've reached for at least the UK and US banking sector. And I think there's been a strong recovery in some of the domestic banks in the UK. 1 or 2 of our managers have been sniffing around at HSBC, for example. It's got exposure to the Far East, which people have become quite negative about over the last year. But the stock market pendulum tends to overreact, and as it's one of the few banks that came through the last cycle without needing state aid or any form of rescue. It's an interesting symbol, if you like, of the idea that something that was yesterday's toxic waste can be tomorrow's opportunity.
And what's your second investment tip?
Well, private equity is another area that we started looking at a few years ago.
And within that, I mean, people hear private equity and I think a lot of people think risk. Is that not the case?
There is a degree of risk, and you have to be confident about who your manager is, because that makes a big difference. What point of the cycle you're buying, because the risk is greater if you're a lot of private equity tends to use borrowings in financing the companies that it backs. And obviously, if you have borrowings going into recession, that can be a disaster. Over the last 2 or 3 years, most of these companies have been paying down borrowings, so they're becoming more secure. Some of the private equity trusts were very cheap a few years ago because of this sort of toxic waste, they might go bust type of fear. And I'm talking about the quoted private equity vehicles, not buying unquoted stocks, which Witten tends not to do. But the likes of Electra, 3i and so forth are ways that the individual investor or the institutional investor can buy portfolios of private equity companies. And if they change their mind or if they want out, they can sell. They don't have to wait till the end of the investment period.
It's liquid.
Yeah, exactly.
And what's your third investment tip?
I think the market is too gloomy about emerging markets. I might be a bit early in saying that, but I can remember 3 or 4 years ago, everybody was kind of talking about the yellow brick road to China, if you like. And I think they, after 10 years, when emerging markets had grown more rapidly than the rest of the world, were seen as fueling the commodities boom and everything, people were very optimistic. And now people, and despite the fact that emerging markets, they said you're getting faster growth, you're paying up for it a little bit, but even so. And now they're saying you're getting slower growth, there are political problems, and people are talking about reducing their exposure to emerging markets, even though they're now on a discount to Western markets. And I think the sentiment cycle might have a little bit further to go, but I think over the next year or two, I think the contrarian will be rewarded by buying into the cheaper asset class.
Is there not an argument that, as you said, they did so incredibly well, exponential growth over that sort of 10, 15-year period in the run-up to the credit crisis? Is there not an argument now that says that nothing can grow like that forever? Is there not a plateau?
Trees don't grow to the sky. Yeah, well, but they are starting from a much lower plateau than we are plateauing out at. And if you look at living standards, whether it's housing standards, car ownership rates and so forth, they're way below those in the Western world. And I'm sure that they're not going to be satisfied with the idea that they can't, there's some natural law that says they can't get to our standard of living. I think what did come out, though, was that a number of emerging markets did well because they were big producers of commodities, and clearly some of the juice has gone out of that. Commodities will benefit from an improvement in global growth, but I think the prices are going to be more modest than we've seen. So clearly the commodity theme has kind of diluted, and that affects 1 or 2 economies like Russia and Brazil particularly. And there are other economies which manage to disguise poor economic management under the general sort of abundant global liquidity, or because they had commodities that were sort of highly priced. So I think you've got to be more stock specific. But I think if you just took the average, the whole of that bundle of emerging market equities was quite highly priced compared to developed markets. As a sort of growth premium 4 years ago, it's now on a discount. And I think if you're selective, I think there's value there.
Andrew, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.